Today, November 16, Microsoft made a new 52-week high, and we detected a massive amount of unusual options activity being traded. And so in this video, we will review what this could mean by analyzing the data as usual. So as you can see from the options time and sales tape, at 11:04 a.m. we have these options being traded, and this is the price. Okay, we can see that this one here is actually greater than this one, because if we multiply out the value, price 7891. As you know, in options trading, the price you multiply by 100 to get the dollar amount. So each of these contracts, 7,891 is how much they paid, and there was 24,500. So this trade started with $193 million. Very, very large trade. Okay, the other amount here, 3612 times 31,500 is actually less, 113 million. So what were they doing? So we believe that they were buying to close the larger amount, this one, the 300 strike call here, closing out of this and rolling them by selling to open the 350 strike calls. Okay, when we take a look at the options chain for the February 2024, we can see the 300 strike calls right over here. You see the open interest 26,000, volume 26,000, buying to close out of these, and opening by selling the 350 strike calls. Okay, you can see the volume here much greater than the open interest. So why are they doing this? Well, to understand this, you also want to understand why they did this initially, what was going on previously. So these 300 strike calls, okay, if we take a look back at the historical data on October 25th, notice here, February 2024, the 300 strike calls are right over here. Volume much greater than the open interest. This is when they sold to open this position. Okay, that's the date. And if we take a look on October 25, we can see that October 25 is actually right after earnings on this day. Okay, so Microsoft, let's say, was trading, ended up in the day around what, $340, right? We can see that also here. This is the end price of 340, and so this is what they did on that day. They had sold to open the 300 strike calls, and they had also bought shares of Microsoft. And as you know, 100 shares is equal to one contract of options. And since on that day it was $340, we can estimate that to be a price of $340 that they paid per share. And so we'll have to add this to our risk profile. Let's take this off. And so this was the trade. Oh, by the way, this trade over here is actually our Microsoft trade. You can see that we currently have. You can see actually the profit on this trade, $1,276 per trade. Okay, we initially got into this for only $226. Right, you can see actually our profits now 1,200. It's about 1,286 divided by 226 times 100. This is currently at 569%. Okay, we got into this trade back on this day here, September 25. So if you've been following this channel, you know, probably saw this video already. If you haven't, we'll put a link at the top here. If you have info cards turned on, you can watch that video on how we were able to catch the bottom of Microsoft here and get in on this trade, making 569% right now. Okay, we made another video on this day following up on this trade, but as you can see, it continues to go higher. All right, we'll put a link also at the end of this video, but let's move on to this analysis. So this is the trade that they got in on October 25th, right? Actually a month after our trade, because we got in on September 25th, earlier than they did. But what they did was they sold a covered call. By selling those calls, they were selling deep in the money calls. Essentially, what that does, right? If you take a look at where they were, 340, you could see that they essentially were lowering their break-even point, right? Microsoft, this is a profit loss diagram. So here is the zero line. Anything above the zero is profit. Anything below is a loss. So the break-even for expiration is actually over here, right? So Microsoft can drop all the way to 260. And by selling these covered calls, they were lowering their break-even from the 340 that they purchased the stock at and lowering it down to essentially collect credit or theta gain on a daily basis. So it's essentially gaining income on a daily basis. You could see that they're Greeks here, a positive 8. Essentially every day they're gaining money for just being in this trade. So they're using the options volatility in their favor, and the Greeks. So this is what this very, very wealthy institutional investor, most likely a hedge fund, was doing. And it also helps hedge their shares. Essentially, that's why they're called hedge funds, because the stock could go down and they could still be profitable, right? So they are in this trade for a very low risk, albeit also not such a high reward trade, but it's a very, very low risk trade where they can create sustainable income and grow their portfolio, right? Because their profits are capped here, as you can see this cap here. Even if Microsoft were to rally, it's capped by selling these covered calls, but they get the benefit of a lower break even, so that if the stock drops, they will not lose. And that's why they're hedged very well to continue to gain money on a daily basis. Okay, so what they did, as you can see now, currently Microsoft, because they are at a high, look at the purple line and the blue line here. There's not much more potential they can gain from that purple line to the blue line anymore. The purple line represents the date today, which is November 16. And as time goes on, this purple line becomes that blue line. And so you can see that the potential profit here is getting very close to max profit here, right, for this trade. And so that is why they decided to roll their trade today. Because you can see now, by closing out of this 300 strike call, they buy it back to close it, and then they sell the 350 to open. So they're selling another cover call, but moving the strike price up higher since Microsoft has gone up. And so by selling this covered call now, okay, so let's take off the 300 now since they closed out of this one. And now you can see that by getting out of this trade again, right? They've now increased their potential profit here, where they can increase more, right? You see how the potential here from the purple line to the blue line, there's a difference. By looking over here, this is the profit here. It shows as the mouse cursors. There's a difference of about $1,300, right? From 3,500 to 4,800, right? There's a profit potential of 1,300 that you could make more of by doing this, because if they had kept it here, you could see that the potential here, the difference here is only $600, right? So they wanted to increase their potential to make more by doing this while staying relatively hedged. So you can see here, this is still hedged. They're break even. They won't lose any money as long as Microsoft doesn't drop below this level here, which is $300 a share, right? The reason why there is, you can also see the Greeks for this trade is a lot more favorable. They have a theta gain of 12. So they have a theta gain of 12 on a daily basis. Whereas the other trade, you could see that it's less. It's only 8, right? And their delta is less, 7.58. Whereas the other trade that they did today, when they rolled it, they get a higher delta, which means they can gain more if the stock goes up. So that is why they did this trade. They rolled it, and so that's why selling these covered calls is a great strategy for these very large institutional investors. And so if this is something that you've learned something and you found this entertaining or enjoyable, please just smash that like button and subscribe if you haven't. And again, if you haven't watched this video on September 25th when we put it out, I'll put a link here. You can learn more on how we use this type of data analysis to get an edge in the market and beat it, all right, by following the wealthy investors and traders in the stock market. Take care and have a wonderful day.